Liquidity. Why it's the hidden engine of the market. Every trader asks, why does the market grab my stop loss before going my way? The answer is liquidity. If you don't understand liquidity, you'll keep falling into traps set by bigger players. But once you see it, the market starts to make sense. In this episode, we'll break down why liquidity is the lifeblood of forex trading and how you can use it to trade smarter, not harder. Section 1. The market moves. Where the liquidity is. Picture a whale swimming in the ocean. A whale can't just eat a single small fish. It needs a whole school of fish to feed. In the market, big institutions are those whales. They need liquidity, a pool of buyers and sellers, to place massive trades. So where do they find it? At obvious points on the chart: swing highs, swing lows, double tops, double bottoms. That's where thousands of traders place stop losses. For the institutions, those stop losses are a buffet. Institutions can't move billions in and out randomly. They need the opposite side of the trade. Liquidity pools. Clusters of pending orders and stop losses. That's why price often spikes to those levels before moving in the real direction. Example. You've seen it before. Price is trending up, everyone buys the breakout, then suddenly, bam, it reverses, stops out the breakout traders, grabs their liquidity, then continues upward. That's not an accident. That's the market moving where the liquidity is. Section 2. Liquidity provides smooth price action. Have you ever traded during the London session versus late-night Asian session? Notice the difference? One feels smooth, the other feels choppy and uncertain. That's liquidity at work. In liquid sessions, London, New York overlaps. Tighter spreads, faster execution, cleaner price action. In illiquid times, late Asian session, holidays, widened spreads, slippage risk, fake spikes with no follow-through. The analogy. Trading in low liquidity is like driving on a bumpy dirt road, unpredictable and rough. Trading in high liquidity is like driving on a highway, smooth and efficient. The takeaway. Smart traders focus on high liquidity times. It's not just about finding setups, it's about trading when the market is healthy enough to move properly. Section 3. Liquidity reveals the market's trap zones. Have you ever thought you spotted the perfect setup, like a double top or a strong support level, only for price to pierce it, hit your stop, and then reverse in your direction? That's not bad luck. It's a liquidity trap. Stop losses gather around obvious zones, above resistance. Buy stops, below support. Sell stops institutions deliberately push price to those zones to collect liquidity. Once the orders are triggered, they use that liquidity to fill their larger trades. The analogy. It's like a hunter setting traps in a forest. The prey thinks they're safe, but the hunter already knows where they'll step. The market works the same way. Practical tip. Instead of placing your trades where everyone else does, learn to wait for liquidity to be taken out first. Once the trap is sprung, that's when the real move often begins. Section 4. Liquidity. Opportunity. I'll tell you about Sarah, a trader who used to get frustrated by stop hunts. But when she learned to look for liquidity grabs, her entire trading flipped. Instead of getting stopped out, she waited for those wicks and false breakouts, then entered after liquidity was cleared. Her win rate skyrocketed. Liquidity hunts aren't your enemy. They're your signal. When you see a stop run followed by rejection, it often means big players just entered. That's your chance to ride with them instead of being trapped against them. The mindset shift. Liquidity isn't just about losses, it's about positioning. If you know where liquidity lies, you can trade with the institutions instead of being the liquidity they use. Your call to action. So here's your challenge. This week, mark out the obvious highs and lows on your chart. Instead of trading them directly, watch how price reacts around them. Does it grab liquidity first, then reverse? You'll be amazed how often this happens. If this episode opened your eyes, hit that like button, subscribe, and share this with a trader who's tired of being stop hunted. And in the comments, tell me, have you noticed liquidity grabs on your charts, and how did they affect your trading? In the next lesson, we'll go even deeper into how to use liquidity zones to plan precise entries, so you stop being the prey and start trading like the hunter. Remember, price doesn't move randomly. It moves to where the money is, and that money is liquidity.